Come for the finance and stay for the debt spiral. So here's where things get really interesting. In the early 2000s, regulators discovered something that sort of paralleled what I described, and it destroyed hundreds of companies. In 2001, the SEC actually opened investigations into a financing structure called PIPEs, which is short for Private Investments in Public Equity. A portion of those PIPEs were what's called floorless convertibles, meaning the lower the company's stock price went, the more shares the lender got when converting their debt. And what that meant was that lenders could hedge by shorting the stock, knowing their bond still guaranteed repayment. So the falling stock price didn't hurt them. And here's how this looked like in reality. First, a company like a tech startup or an internet company would run out of money. So traditional banks wouldn't want to lend them money because they were considered too risky. So in comes a hedge fund or a specialized investment bank offering something that sounds really helpful. We're going to lend you money, but instead of paying us back, you could give us more shares. We'll just take your stock. And if your stock goes down, don't worry, we just get more stock, right? Now, to a desperate company, that sounds really good, but this adjustment mechanism where the lower the stock price goes and the more shares the lender gets is what gives financial incentive for the company's stock price to fall. Because the lower it goes, the more shares the lender gets. And once they get those extra shares, they could sell them into the market, which does what? Pushes the price down even more, which gives them even more shares, which they could sell again, and so on and so forth. In a study published in 2001, the SEC reviewed hundreds of these cases, and what they found was that on average, investors who bought the stocks of these companies lost about 34% of their value within 1 year. By the end of it, about 85% of those companies had negative returns after creating their toxic debt, and about half of them didn't survive. 48% of those companies were delisted.